In this video, I'm going to discuss the accounting for income taxes and more specifically, how we deal with deferrals in accounting, in financial reporting. So to give you a little background, the reason why we have to have this particular topic on tax deferrals is because we have, for financial reporting purposes, we follow a set of rules that we know as generally accepted accounting principles. And in general, this is going to be the accrual basis overall, meaning we recognize revenues at the moment that we earn them, independent of when cash is collected, and we recognize expenses when we incur them, independent of when we actually pay those expenses. So that's, for GAAP purposes, the rules of recognizing revenues and expenses. For tax purposes, it's a little bit different. The Internal Revenue Code follows what could be described as a modified cash basis. So instead of following the accrual basis that we use for financial reporting purposes, under taxes, it's mostly a cash basis approach. So anytime you receive money, you will recognize it as taxable amounts, and anytime you pay money, you will recognize it as deductible amounts. So just understanding the difference between accrual and cash basis can allow you to see why we have these timing differences. The reason we, the reason why we have these different reporting regimes is because they all, each one of them serves a different goal or a different purpose. For financial reporting, our goal is to provide useful information to outside parties, okay, so that all stakeholders can have information about those public companies or those companies that report under the SEC requirements. And that's a different goal for tax purposes. For tax purposes, the government is collecting enough money to support government services, and as such, these two goals are different, and hence the reporting requirements different. So what happens is that because of these two different regimes, you have timing differences. And some of those, and when I say timing differences, I'm talking about the timing differences related to revenues earned that need to be recognized for financial reporting basis, but they may not be recognized for tax purposes yet, if maybe we did not receive the cash or something like that. So how do we account for those temporary differences? We do some type of reconciliation through the use of deferred tax assets and deferred tax liabilities, and I'll explain that in a minute. And also, we have some differences that are permanent, and when we have differences that are permanent, we don't account for the deferrals related to it. So I'll give you some examples because that might be hard to understand. But for example, under tax, for tax purposes, you're not allowed to deduct any fines that a company incurs for breaking laws. Even though for financial reporting purposes, we will record that expense, for tax purposes, you're not allowed to take that deduction. So you'll have a permanent difference because of that. Another one is there are some government securities that pay tax-free interest, which means that you'll recognize the income for GAAP purposes, and you'll use that for purposes of computing income tax expense. But then for tax purposes, you're not going to pay taxes on it. Okay, so that's another example, and then there's several others, like the premiums or the proceeds you receive from the life insurance that a company takes out for key officers. And don't confuse these with the regular life insurance premiums that are paid for all employees. Those are deductible. But when you take out life insurance policies on key officers, just a few people, select group, those are not deductible. And then if you ever collect on those life insurance policies, then that is not taxable. So again, that creates timing differences, because for GAAP purposes, you are going to recognize the expense for the premiums to those life insurances, but then for tax purposes, you do not recognize that expense or that deduction. Okay, So notice how, this might be clear to you, but just in case, when we refer to revenue here, or whenever we refer, when we talk about financial reporting purposes, we talk about revenue, and then under tax purposes, we could call it revenue or just taxable amounts, right? But we're kind of referring to the same thing. Whenever you recognize revenue, that eventually will be a taxable amount for the most part. Or if we're talking about an expense here, the equivalent will be a deductible amount. Just so we won't get mixed up with the verbiage here, okay? So let me give you an example here of how these temporary differences, the ones we're describing here, arise and how we account for it with this deferred tax liability or deferred tax asset account. Let's start with scenario number 1 here. So PTI stands for pre-tax income, so this will be our GAAP income. And TI is taxable income, which will be our IRS or Internal Revenue Code taxable amount. So whenever you have a scenario where the pre-tax income is greater than the taxable income, or if you, sometimes it might be easier to just think about it the other way around. If your taxable income is lower, then the amount that you're going to pay for taxes is lower than the expense, the tax expense you recognize. Okay, so this, for example, here is how the transaction would look. But before I do that, what are some situations that give rise to this scenario number 1? Under accrual basis, since we have to recognize revenues when earned, we might have some revenue that for which we have earned that we have not received the cash. Well, if we've earned it for financial reporting purposes, we have to recognize it, even though the cash has not been received. And then for tax purposes, since the cash has not been received, you don't recognize that taxable amount. So that would be one example. The other common example with this is depreciation under tax code is usually more accelerated than the depreciation methods we use for financial reporting purposes. So commonly, you'll have, when you have an asset you're depreciating, commonly you'll have tax depreciation be much quicker at the beginning than financial reporting depreciation. So what ends up happening is that you have, again, timing differences that eventually reverse. In the same way that, if you recognize this revenue that you earned, but for financial reporting purposes this period, but not for tax, later on, next period, when you get the cash, you will record that taxable amount. So because of that, these reverse. These are temporary differences. Same thing here. That extra depreciation eventually reverses over time, where later the tax depreciation is lower than the financial reporting. So what do you do, in that case? Well, since our taxable income is lower, what you pay, this is the amount you pay to the IRS, is going to be lower than what you record as tax expense. So your tax expense for GAAP purposes is the expense incurred based on pre-tax income. And the difference here is transferred to deferred tax liability. And the idea here is that eventually, even though in this period you have less to pay than what you recognize in expense, that will flip in the next period when the opposite is true. So then in next period, you'll remove that DTL, that deferred tax liability. And I'll give you an example in a minute here so that you can more easily see what I'm talking about. On the financial statements, this would be a current liability, what you're going to have to pay the IRS. And the deferred tax liability would be classified as non-current liability. And there's some debate as to whether this is entirely true or not, because in the deferred tax liability there is a current component that will reverse in the following period, and there's usually also a long-term component. So to classify it all, as long-term or non-current can be thought of as deficient in nature, but for practicality purposes, the FASB, Financial Accounting Standards Board, decided to just classify the whole thing as non-current liability instead of having companies have to break apart what is current and what is non-current. So the way we report it, the amount you're going to pay the IRS, that's current liability, and then any deferred taxes, that's non-current. Second scenario, this is the opposite here, where taxable income becomes greater than pre-tax income. So it might be easy to think about this. If taxable income is greater, you're going to have to pay more taxes. So the amount you send to the IRS is more than what you actually record as tax expense in that period. So in those scenarios, what arises is a future benefit, a deferred tax asset. And I highlight this here because there is a test that needs to be done for the asset, which I'll explain in a minute. But if you've seen the trend, anytime we have an asset, we always test it to make sure that it's not overvalued. So this is an overvalue test or an impairment test. But let's talk about this. So this could be the scenario where for tax purposes, I have to pay $3. But then for financial reporting purposes, my tax expense is $2. Well, that gives rise to a deferred tax asset. All right. So all this quick introduction here with the deferrals, okay? This is what I meant by accounting for tax deferrals. All this stuff that we do, keep in mind, this is for financial reporting purposes. All right, so on your tax return, you're not doing any of that. This class is focusing on financial reporting. So these are the things that we have to incorporate in our financial statements as part of the normal GAAP rules. Now, for this deferred tax asset, for some companies, this becomes large, and as it grows, you have to test it for impairment. So the test is the most likely than not test of realization. So in other words, we ask ourselves, if at any point it is most likely than not that part of this or all of it may not be realized, then we have to write it down. And the test is if the probability is greater than 50% of not realizing it, that's your threshold, then you write it off. And of course, these things are, when we say more likely than not, it might give us comfort to say, okay, greater than 50% probability. But even then, how do you determine that something is greater than 50%? It's not easy, okay? And this is where the subjective part of decision making comes in. Now, what could give rise to a deferred tax asset that may be impaired? Think about it. If we have, you've learned about contingent liabilities in the past, or contingent losses. So perhaps we get sued by somebody and then we estimate that the probability of loss from that lawsuit is probable. If that's the case, you've learned in the past that then if it's probable that you're going to lose that case, you have to recognize an expense and a liability, right? For financial reporting purposes. So when that happens, your pre-tax income is lower than taxable income because you're taking an expense for something you have not paid. So it's a financial reporting expense, but you do not have to pay it, so taxable income is higher. Well, something like that will give rise to a DTA. What could happen? It could be that you actually win the case. And if you win the case, then this deferred tax asset that you created really was unnecessary. And that could be one of those scenarios that flips this around and you say, you know what, my deferred tax asset is overstated. This particular change arose. Or sometimes you might encounter, there's a ton of examples, of course, but sometimes you can encounter an extended period of expected losses. Maybe something happened in the company that, it's a regrouping, it's a re-engineering, it's something big, and you just foresee losses for a while. In that case, you might question whether this deferred tax asset can actually be used in the future. And then you might have to write some of it down. In any case, whatever moment you determine this, the accounting for it is you recognize an expense at that point, sort of like the additional expense that you never recognized. You can think of it that way. And then you create an allowance for that deferred tax asset. And if a situation arises that you deem that now you have a deferred tax asset that you can use, then you can reverse this later on, but up to recognized expenses or recognized impairments. Okay. All right. Let me give you an example here that might help us see the flow of information a little bit better. And here's a quick little example. Company, whatever the name of this company is, the company has pre-tax income of $300,000 on year X1, and they pay 40% tax rate. So for financial reporting purposes, you have $300,000 of pre-tax income. So your tax expense is going to be 300 times 40%. And that's straightforward. This will be on your financial statements. Then this company also has a couple of temporary differences for year X1. In year X1, tax depreciation is greater than financial reporting depreciation by $40,000. Since this is the case, taxable income is going to be lower. And whenever taxable income is lower, I'm putting myself a little reminder here. I have a deferred tax liability. So recall our two examples here. Okay, this scenario 1 gave rise to a deferred tax liability, and then scenario 2 gave rise to a deferred tax asset. So go ahead and use that as a potential reminder of what to do. Oh, by the way, I don't know if I mentioned it, but in the same way that taxes payable here was current and deferred tax liability was non-current, deferred tax asset is also listed as non-current asset on the financial statements. And then this I already spoke about. Okay, so let's go back over here again to the problem, the example. So in the first one, since taxable income is going to be less, I have a deferred tax liability. And it's going to be less by $40,000. And it's noted here that the $40,000 will reverse equally over the years X2 through X5. So here I'm doing X1, and then here I'm doing the year X2, so you can see how it starts reversing. So the first thing we'll do is, for that $40,000 difference of expense, I'm going to have a deferred tax liability of $16 as recognized right here. So I will create a T account here so you can visualize it, and that's what I mean by this. The $40,000 difference creates a $16,000 deferred tax liability. Okay, and that eventually starts reversing out. Now B, the second difference here, $20,000 rent for X2 was received in advance in year X1. Well, for financial reporting purposes, we would record a prepaid rent, right? Because we're receiving money ahead of time. But we, my mistake, not prepaid rent. We would record an unearned revenue because we're receiving money ahead of time. So let me, reiterate. So if we are receiving money from a tenant, let's say, and we receive that money ahead of time, we would record the cash inflow of $20,000, and then we would have an unearned or liability, unearned revenue for the $20,000. That's not the case for tax purposes. For tax purposes, if you receive the money in X1, you will have a taxable amount of $20,000. So because of that, you're going to have higher taxable income in X1 than pre-tax income, and this gives rise to a deferred tax asset. So the deferred tax asset right here is $8, which is the $20,000 extra of taxable income times the 40%. And that's your deferred tax asset of $8 here. All right. We could figure out what this income tax payable amount is by simply plugging the amount if we have these three figures. But think about it. You could also go in there and say, well, if pre-tax income for GAAP purposes was $300, that was this, and I had $40,000 additional depreciation for taxes, so I would subtract that the 40 from the 300, and on top of that I had $20,000 extra because of that rent received ahead of time. My taxable income is $280,000, and hence my tax that I have to pay is 280 times the tax rate of 40%. So that's where this income tax payable of $112,000 arises. All right, next year comes around. Here's fiscal year X2. We're told, this is just given, that taxable income is $325,000. Okay, so very quickly I can do this right here. And my income tax payable is $130,000, 325 times 40%. But now we got to think about how some of these things reverse. That rent that was received ahead of time is not going to be recognized for tax purposes, but it will be recognized for financial reporting purposes in year X2. So in other words, we're going to have a scenario where for that particular item, tax expense will be higher than income tax payable, because of the fact that pre-tax income is going to receive $20,000 in X2, but not taxable income in X2. So that is the reversal that we see right here. So we will remove the income tax effect of $8. That flips around, and that means that we remove the DTA. So after this transaction is done, your deferred tax asset balance is 0. And you have accounted completely for this temporary difference. Now, for the depreciation component, it was noted that the whole $40,000 would reverse equally over the next 4 years. So what that means is that of this $40,000, each year $10,000 reverses. So that's where here you have the $10,000 and its income tax effect of 40% is being reduced from deferred tax liability. And that's what I have right here as well. Okay. So given that information, you start seeing how this right here decreases to 12. And in terms of the tax expense that is recorded here, you could just plug it in. You know, if you have these three data items, then you can figure out what tax expense is. Or you could reverse it out. It's not obvious. It's not so obvious sometimes, but you know, especially given the limited information we have here. But we could think of it that way, this way. If taxable income is $325, to arrive at pre-tax income, we'll first subtract out the $20,000 for the rent. So in other words, this year pre-tax income is going to be lower by $20,000 because we recognized that $20,000 in pre-tax income last year. So this year is going to be lower. And then this may not seem so obvious, but in terms of the depreciation, the difference is going to be $30,000. We started out with a difference of 40, and then we reduced 10 here, so the difference remaining is 30. So we would add that back, and this would give us 335. And if you do 335 times the 40%, we should get the 134, yes. Okay, so just for the sake of completion, let me go ahead and write that down here. 335 times 0.4 gives you the 134. Okay, so this concludes the discussion on accounting for tax deferrals. Having had the discussion, you can appreciate now some of the complexities that arise because of timing differences. And in this example, you can see how that information flows.